Okay, so this is where we roughly left off last class. We were talking about how borrowing does have the ability to change the value of the firm overall in the presence of taxes. We saw that that was not the case without taxes. There was no way for the firm to increase its stock price essentially by levering up, using the logic that investors are also having the ability to borrow as well in the same credit markets. And if they're able to replicate the returns to a levered firm by borrowing themselves and investing in an unlevered firm, those two investment strategies have to have the same cost. And so under those conditions, with no taxes, with costless transactions, where the cost to the investors is very small of making those stock purchase transactions, and then the fact that the investors have the same borrowing rates available to them as the firm. Those are the conditions that were required for the Modigliani and Miller Proposition 1, which just said that the value of the unlevered firm was equal to the value of the levered firm under those conditions. No taxes. Investors have access to the same borrowing rates as the firms do, and the transactions that are associated with those purchases of those securities, those are costless. Those are frictionless. There's an ability to make all those purchases and sales without any friction. So that's where we've been. We're now going to consider the value of the firm, how the firm value changes in the presence of taxes. And so we have that. We introduced that a little bit last class, where we have this this basic rule here on the left-hand side, or on the bottom of this slide, where the value of the levered firm is going to be the same as the unlevered firm, but there's going to be an extra something over here that's going to add to the value of the unlevered firm. What that happens to be is the present value of the interest tax shield, or the present value of all the tax savings that the firm is able to gain as a result of having some debt on its books. So we can think about that. Let's think about this just systematically. This B represents the debt that's on the firm's books. That's the amount of borrowing that it incurs. This RB is the cost of debt. Essentially, that's the interest rate that the firm is paying on its debt. So the per period payments that this firm is going to have to pay are the simple product of these two parameters, the amount of debt and the cost of debt. That's the interest that they're paying. Now, the fact that interest payments are tax deductible means that this amount, RB times B, that amount is able to be subtracted from pre-tax income, and therefore that avoids the IRS. When you have money that you're paying off to bondholders, that money circumvents the IRS or bypasses the IRS, and so you avoid paying those taxes. In the absence of these interest payments, RB times B, the taxes that you would have to pay on that money would be given by this. It'd be the interest payments that you, in the event that you're not paying that amount of interest, that's part of your taxable income. That gets multiplied by TC, which is the corporate tax rate. That gets indicated, or that gets multiplied by TC, the corporate tax rate. And so that's the additional taxes that you would be paying if you weren't deducting the interest that you are in the presence of that borrowing. So that's the extra cash that you have available to you because you've taken on some of that debt. That's where the firm value can diverge in the instance where there are taxes. That's where the firm value of the unlevered firm and the levered firm can actually diverge. Okay, so from that last slide, the last slide we had RB down here at the bottom. We had RB times B times TC. That's the value of the tax savings. Those are, you can think of those as additional cash flows to the firm. That's extra cash that's available for the firm, and that's going to be, you know, if we could have a terminal date on this debt. Maybe there's some time to maturity. Maybe this debt is coming due in 10 years or 20 years. But you know, a firm may find it optimal to keep, you know, just to keep a certain amount of debt on its books indefinitely. Maybe, you know, once one bond is maturing, once one bond reaches maturity, maybe they renew that and they continue financing their operations with debt. And so it's actually possible to have indefinite or debt on a firm's books indefinitely, as long as they're paying interest on that debt. The bondholders don't mind loaning them that money. So there's no problem in thinking about debt being held on the books in perpetuity. As long as they're paying interest on that debt, then that's a fair transaction to take that debt on and then to pay interest every year or every half year to the bondholders. So we can think of this as being additional cash flows. You know, if we want to, it could have a terminal date, but we're going to think of them in perpetuity. We're going to think of those as being in perpetuity. So these are going to have some risk associated with them. Just as any cash flow of the firm has some risk associated with it, these cash flows have some risk associated with them. But the key point here is that you can consider these additional cash flows as having the same risk as debt itself. You know, so the operations of the firm, the residual flows to equity, can go up and down according to, you know, the prices of the products and services that the firm is selling. So those things have some risk associated with them, and the residual cash that's available to equity holders is going to have some risk, obviously, associated with it, depending on market conditions and the performance of the firm in a given quarter. There could be higher cash flows or lower cash flows, and therefore more or less money available to pay out to equity holders. However, these cash flows, you know, as long as the firm is still paying interest, you know, as long as the firm keeps up these interest payments, these are the amount of savings that it's going to generate as a result of having those interest payments. It's going to be able to save the amount of the interest payments, which is RB times B, and the tax savings associated with that is TC times RB times B. So these cash flows from these interest payments, or the cash flows associated with this debt tax shield, those are going to have the same risk profile as debt itself, because those interest payments have to be paid first before equity holders can be paid off. So it's going to have this less risk than equity, and in fact, it'll have the same. You can think of it as having the same risk as the debt itself. And so the appropriate rate at which to discount these cash flows, which are tax savings, the appropriate rate to discount them is the rate that corresponds to the same risk as these cash flows. And in this case, the risk that bondholders are attributing to these cash flows is RB. And so that's the rate that's appropriate to use to discount those cash flows in perpetuity. So this amount, RB times B times TC, is a cash flow that's going to be extending out into the indefinite future. And so we can compute the present value of that, just as we were saying that this this extra firm value is the present value of the tax shield. We can use that that RB to discount that cash flow and actually come up with a an expression for what the present value of those cash flows are. Okay, so let's go over just briefly and contrast the value of an unlevered firm first. So this we've been using the notation VU to denote that. We can think of this as being the earnings from operations before taxes and interest, EBIT. You can multiply that by 1 minus the tax rate. There's going to be some taxes that come with those earnings. And this is earnings before interest and taxes. There's typically, interest would be deducted from this, but this is because the firm is unlevered. There's no additional interest that has to be paid out. So this amount here on top, or this first term I've written down, that's the annual after-tax earnings, and then that gets discounted. We can think of that as being a stream of income, a stream of earnings for the firm over time. And because the firm is unlevered, the appropriate discount rate for these cash flows is the unlevered cost of equity, which is just RU. Sometimes the textbook will use R0, and at times I may slip back into that. So R0 is the same as RU. That's the cost of capital for the unlevered firm. So the value of the firm overall is simply the annual after-tax earnings divided by the cost of capital, presuming that these earnings persist into the indefinite future, forever. That's the unlevered case. Now let's think about the levered case. In the case of the levered firm, the underlying activities of the firm, the sorts of business operations it's undertaking are identical, regardless of how it finances its stuff. So we can think about it still has some cash coming in. And in fact, we can, we think about this relationship here that we had brought up before. The Modigliani and Miller Proposition 1 with taxes says that this firm value is equal to the unlevered case, the value of the firm in the unlevered case, plus the present value of the interest tax shield. So this can be expressed here by simply the value of the unlevered firm. So we have that value already right here. And remember, in the absence of taxes, that's the same for the unlevered firm as for the levered firm. Even though there's interest associated with the cash flows of the levered firm, that gets taken into account by investors. And at the end of the day, from that Modigliani and Miller Proposition 1, that without taxes that we talked about, that value, that overall value of the firm is actually going to just remain constant, regardless of how much leverage is taken on in the absence of taxes. With taxes, the only difference is that now there's an interest tax shield, which, if we remember, we had RB times B times TC. That was the additional cash flows. That was the additional cash flows from having that debt, having those interest payments be tax deductible. And then we discount them. Remember, we talked about discounting those at the cost of debt. So if we're thinking about the overall value of the firm is the present value of its cash flows from operations, that's this first term on the left. And then the present value of the cash flows from tax savings, that's this amount on the right. If we discount that and consider that as a perpetuity and discount that into the indefinite future, we'll notice that this RB is in the numerator and the denominator, and so we can rewrite that as simply the EBIT times times 1 minus taxes, the after-tax EBIT, divided by the cost of capital for the unlevered firm, plus the present value of this interest tax shield, right? So we go from this slide, considering the present value of the interest tax shield, and that eventually collapses to just B plus the tax rate, the corporate tax rate. Okay. So now that's how the firm value changes. So in fact, we could even simplify this. Let me duplicate this slide one more time. We're going to go from this expression here, which is more complicated. We can actually just simply re-express this as the value of the unlevered firm plus the present value of the interest tax shield, right? This is the value of the levered firm. VU, unlevered firm value plus the amount of debt times the corporate tax rate. So that's Modigliani and Miller 1 with taxes. Okay, that's with taxes. The second, if you remember what the second Modigliani and Miller proposition dealt with the cost of capital. And so to think about this this cost of equity capital, I want to derive this just from first principles, just thinking about balance sheets, thinking about cash flows from assets and cash flows to equity holders and debt holders, and we can actually derive Modigliani and Miller proposition 2 just based on some of these balance sheet and cash flow balance identities. So I'm thinking just very abstractly about a firm's balance sheet. There's going to be some assets and some liabilities and equity. The assets of the firm are going to be, the value of the unlevered firm plus any value of interest tax shield, right? So if there's no debt, then the value of assets are just the value of the unlevered firm. But if there is some debt, the value of the firm is the sum of the unlevered firm plus the present value of the interest tax shield. On the other side of the equation, we have debt and we have equity, which is the value of the firm minus the debt. So that's just a reminder of our simple balance sheet identity. Now, if those are the assets and the liabilities, the cash flows from those assets are going to be distributed into one of two places. Either there's the bondholders are going to get some, and then the stockholders, the equity holders are going to get some. And so this simple balance sheet gets translated into thinking about these assets generating cash and these liabilities representing flows out of the firm of cash. We can sort of re-express that as the value of the unlevered firm, the value of the assets of the unlevered firm has to return some rate of return for its investors. So I had initially called this R0, but I'm going to re-express this RU just to kind of be consistent with my previous notation. The assets of the firm, of the unlevered firm, have to return a rate of return equal to the cost of capital for the unlevered firm. And so that's these assets are going to generate a flow of cash equal to this amount every year. It's kind of like, this is like the interest, or the extra cash generated from each of these assets that are on the balance sheet. And the extra cash generated from the debt are these the value of this tax savings, which we've already talked about. So those are the cash flows from assets. Those are going to either go to equity holders. So that's going to be a function of how much equity is in the firm multiplied by the required return on equity, how much equity, or what the rate of return is that equity holders require. And then bondholders are also going to want to be paid, the cost of debt. So this cash on the left-hand side generated from assets gets transferred in some combination to equity holders and to bondholders. So we can start there, and then we can. So that's just what we have up here. And then we can divide each of these. Divide this top equation by S. So we're dividing this by S. We divide by S here and here to go from the top to the bottom. I'll put these notes up so you don't have to necessarily have this all written down, but there is a derivation of this in a textbook as well. But I think it's helpful to think about where this comes from. This will eventually lead us to Modigliani and Miller proposition 2 with taxes. So if we take this bottom portion, we can consider where that leads. That's the same as, we go from this bottom expression on this slide. That's equal to the top expression on this slide. Those are the same things, except I've brought this term over to the left-hand side in going from this expression to this expression. So now that term is right here. I've just, to go from this top expression to the bottom expression, I've just rearranged this a little bit, and I've combined this term here with this term here, and I've combined them all into one, just right there. This first term on the left-hand side just becomes VU times the cost of unlevered equity. Just for consistency's sake, let me just make sure that this is expressed in the same terms. So we go from the top to the bottom, just kind of rearranging terms a little bit. Now we have this VU. We have this VU on the left. We can actually re-express that if we remember what the balance sheet identity says. The balance sheet identity says that the value of the levered firm is the value of the unlevered firm plus the present value of the interest tax shield. That's according to the balance sheet. That's got to be some combination of the equity and the debt. So the debt is the B, the equity is the S. If we rearrange that and we bring the present value of the tax shield over to the other side, that actually gets combined with this debt term, and we have the value of the unlevered firm equal to 1 minus the corporate tax rate times the value of the debt plus the value of equity. So that's the value of the unlevered firm. That's what VU is. And what we're going to do next is just insert that value right in here in this expression to derive Modigliani and Miller proposition 2. So again, we're just taking this equation and plugging it back in right here. Okay, so this is what we started with. We started with this value of unlevered firm. I'm just going to change this. Right now, the value of the unlevered firm that we had just derived on the last slide is 1 minus tax rate times debt plus equity. Okay, so that's what this equation looks like now. The last thing that we can do here is we can cancel out some terms. We have our, this right hand term, this s underneath RU, and this s on the left hand side, that's going to cancel out, and you're just going to be left with RU plus 1 minus tax rate. Okay, so essentially what's going to happen is this term here is really similar to this term here. So those can be combined together. All right, now this is all going to imply that if we combine this part, if we combine this with this right here, we're going to get on the left hand side of this equation, we can put RU on the left hand side. That's going to be this RU plus 1 minus corporate tax B over S. Those are common terms between between this part and this part. And then what's left over is just RU minus RB. And then we have the right hand side, which is just RS, right? So this is the expression for, essentially this is Modigliani and Miller proposition 2 with taxes. Okay, and this looks really similar to Modigliani and Miller proposition 1, or sorry, Modigliani and Miller proposition 2 without taxes. The only difference is this term, this tax term on the this 1 minus tax rate on the left hand side of this equation. This was the same structure, identical structure. There's just 1 minus tax rate added on or multiplied to the second term on this left hand side of this expression. So that's the relationship between the cost of equity capital RS, the relationship between the cost of equity capital RS and the cost of unlevered capital and the debt to equity ratio. Okay, so that tells you the cost of equity capital given any debt to equity ratio, given any tax rate, given any cost of debt, and given any cost of equity capital for the unlevered firm. So that's eventually what we have here on this slide. I wanted to just go over and make sure the math on that was clear. So now that we have that, remember this relationship, this Modigliani and Miller relationship, all of this just came out of the this just simple balance sheet identity or cash flow balance identity, remembering that this is what a balance sheet looks like. And we know that the cash flows from the firm have to be, distributed either to equity holders or to debt holders. We know what the cash flows of the firm are going to be based on their return to equity, or sorry, their return on assets, and then the the cash flows from the present value of the tax shield. So all of that follows pretty logically to produce Modigliani and Miller Prop 2. Let's look at an example of how to solve a problem like this. So we have a firm here which has earnings before interest and taxes of 153.85. We're just going to assume that these are going to be persisting forever, annually. We're going to have a corporate tax rate of 35%. And what this is going to imply is that the after-tax earnings, if we apply a 35% tax rate to 153.85, that's going to imply interest. That's going to imply interest equal to $53. I'm sorry, not interest. It's going to imply taxes of $53.85. So the after-tax earnings are going to be $100 in that case. Okay, so the key exercise we're going to try to do here is consider what happens if this firm starts out as an unlevered firm, and then eventually refinances some of its activities, taking on $200 worth of debt, essentially buying back existing equity, buying back existing stock, and replacing that equity with debt. The debt is going to have a certain cost. The cost of debt is going to be 10%. And the firms in this industry, unlevered firms in this industry, have a cost of equity of 20%. It's sort of expected. Investors in this industry, given the risk profile of the activities in this industry, the investors expect a return of 20% on the equity that they put in, if the firm is unlevered. If the firm is levered, they're going to require more, and we'll see that here in a second. So we have these three questions, A, B, and C. What is the unlevered cost of equity? What's the levered cost of equity? And then what's the weighted average cost of capital once we account for the new borrowing that's taking place? All right, so the first of these questions is pretty simple. It's just actually one of the parameters that's given in the problem. The first question was, what is the unlevered cost of equity? Well, that's just given by what investors are requiring of firms of that type that have a certain risk profile associated with their cash flows. That's going to be given by the capital asset pricing model that we had discussed in lesson 7. That's going to be given by opportunity cost of money, what alternative investments of similar risk tend to return. And so that's just going to be this 20% amount. In this case, that's just a given parameter. That's going to be the cost of capital for the unlevered firm. Okay. Now the second question is a little trickier. It's going to be what's the cost of capital, or what's the cost of equity capital for a firm that's levered up. In this case, it's borrowing $200, right? We know generally that the total value of the firm is, just from the balance sheet, we know that it's the amount of debt, the value of the debt plus the value of the equity. So if we know that debt in this case is $200, we know that from the fact that this restructuring has given the firm an extra $200 of debt, and they've used that to buy back equity. The question then is, what is the value of equity after this debt is taken on? Okay, so that's what we're aiming for. We're aiming for S. We're trying to find this S. Now, to find S, we actually have to know what the overall value of the firm is when it levers up. And so the way we find the value of the levered firm is we first figure out what the value of the unlevered firm is, and then we determine the present value of the interest tax shield. So this is just going to be the equation that we had been working with before. The value of the levered firm is equal to the unlevered firm. That's true straight up in the case of no taxes. But in the case of taxes, there's the present value of the interest tax shield, which gets added on to this amount. So we're going to be looking for PV tax shield. First, to figure out the value of the unlevered firm, we take the EBIT, we multiply it by 1 minus the tax rate to get the after-tax earnings, and then we divide that by the unlevered cost of equity. So that's just this 100 divided by 0.2, and so the value of the unlevered firm is merely $500. Now the leverage is going to provide an interest tax shield, right? So, and we know from this identity up top, this Modigliani and Miller 2 with taxes, we want to compute the present value of the interest tax shield, which in this case is just merely, it's just the tax rate, corporate tax rate, times the amount of borrowing. So in this case, the tax rate's 35%. The amount of borrowing is $200. And so the present value of that tax shield is $70. And so overall, the value of the levered firm is 570. So that's the value of the levered firm under taxes, according to Modigliani and Miller 2 or Modigliani and Miller 1. Sorry, this is actually Modigliani and Miller 1 with taxes. All right, and now we know that the amount of borrowing that this firm has undergone is 200. So just again, going by this identity of value of the firm equal to the value of debt plus the value of equity, we know the firm value is 570. We know that the borrowing is 200, and so we know that the value of S, or the value of residual equity in this case, is 370. So the value of equity in the unlevered case was 500. It was just equal to the value of the firm. There was no leverage, and so the value of equity was just the present value of the after-tax earnings. Now, with this debt, the overall firm value goes up a little bit. It goes up from 500 to 570, but the equity is a little bit, it gets diluted. Some of the debt is used to buy back pre-existing equity, and so that's where this debt is subtracted from the total firm value, and that's what gives you the residual equity that's left over after the firm borrows, after the firm value increases, and then after you take away the amount of debt that's on the books, then you're left with 370 of debt value. Now, this is where Proposition 2 comes in if we're trying to find the cost of equity capital. So Modigliani and Miller 2 with taxes is going to be the operating principle here. Just plugging these numbers in again. Remember the cost of unlevered equity, just by assumption, was 20%. That was the required rate of return on firms in that industry that have that sort of risk profile. The cost of debt was 10%, and then we were looking for the debt to equity ratio. The debt, again, is 200. The equity we just calculated up top, that's 370. So the debt to equity ratio in this case is 200 divided by 370. And then the last component of that second term in the Modigliani and Miller 2 with taxes expression is just you multiply that amount times 1 minus the tax rate. Taxes in this case are 35%. So putting that all together, you end up with an after leverage cost of equity of 23.51%. So that's the required rate of return on the firm's equity after it has borrowed $200 and bought back $200 worth of stock, essentially. So that's the RS. RS, we were looking for a couple things here. We were looking for RU. RU was just 20%. That was what was expected of the firm under no leverage. That was a given parameter in the problem. The second thing we were looking for was what's the cost of equity for a firm that has taken on some debt. That should actually, looks like there's actually a typo. That should be not all equity firm. That should say levered firm. So we saw that the cost of equity capital has gone up from 20% in the unlevered case to 23.51 in the levered case. Now we can, the last question we had here was just what is the weighted average cost of capital? We're just merely going to take all the values that we had previously computed and just plug them back into what we know to be our WACC expression. The equity share of the firm times the cost of equity under leverage, plus the debt share of the firm times the cost of debt times the tax rate. So this WACC, the structure of this WACC in the new kind of in the new world where leverage affects the value of the firm, these shares are now you can't just merely take the pre-equity or the pre-borrowing equity and add it to the debt. You actually have to calculate the value of the levered firm. So this is the key step. We had to calculate the value of the levered firm. Right, so that's the weight, that's the equity share. We multiply that by the expected return on equity. That's the RS that we calculated using Modigliani and Miller proposition 2 with taxes. That's going to be added to the debt share, again divided by the overall, or the amount of debt divided by the overall value of the firm, which changes under borrowing, times the cost of debt, times the tax rate. So plugging in, we have the value of the firm is 570. Overall, we have the 23.5% that we calculated before. We have the new equity. We have the new amount of debt, cost of debt, tax rate. Plug all those in, and we find that the 17.54% is the weighted average cost of capital after we account for this borrowing, which affects the share of equity and debt in sort of a complicated way because we have to calculate the value of the levered firm. And then we plug that into just our known expression for WACC that we've seen from lesson 8. Okay, so this is going to give you what you need for the homework 9. I don't believe any of the Connect problems have this sort of thing where you have to recalculate the value of the firm in the leverage case. I believe most of those are just in the no tax world. But the Canvas problem that's posted on Canvas as part of your homework is going to have a problem that requires you to solve this sort of problem where you have to recompute the value of the firm with debt, and then figure out what that means for the cost of equity given that leverage, and then recompute the WACC under those new costs of equity and the new shares. Okay. So this kind of brings us to the close of lesson 9. Or actually, I might have a little bit more lesson 9 material that's a little bit different, but this is like the sort of the close of this Modigliani and Miller stuff. There might be some stuff that I cover next week about just thinking about how capital budgeting with this leverage, kind of bringing in some of this cost of capital and the changes in cost of capital under leverage, and how that could maybe apply to some of the lesson 3 and 4 material that we did when we were computing present values of projects. So I think I'm planning on maybe doing some of that next week as well, and that sort of fits under this lesson 9 stuff. But this Modigliani and Miller propositions 1 and 2 with and without taxes, that material is all covered here, so that will set you up nicely for homework 9.